Well, President Biden highlighting bright spots in the progress of the U.S. economy at the Economic Club in Washington, D.C. Biden celebrating a new milestone after the Fed made its first rate cut in 4 years.
The Fed lowering interest rates isn't a declaration of victory. It's a declaration of progress. It's a signal we've entered a new phase of our economy and our recovery.
Biden also clarifying that while inflation has come down, there's more work to be done. Joining us now, White House Council of Economic Advisors Chair Jared Bernstein. Jared, it's great to see you.
You as well.
So let's, I guess, get to the more work to be done part, right? Which is that the idea that the Fed is being sort of proactive here in part to forestall any further sharp deterioration in the labor market. How are you in the White House thinking about that part of the equation?
Well, the job market remains, I believe the word Powell used yesterday was solid. We have an unemployment rate that's historically still quite low, 4.2%. And the pace of job gains, while it's definitely slowed, is still at a rate that's associated with maybe the lower end of what we think of as the break-even rate, meaning the number of jobs you need to keep the unemployment rate pretty stable. What we're seeing in the broader economy, because remember, the labor market is a function of consumer spending, investors, and we see healthy developments in those critically important sectors. GDP growth, of course, is coming above trend. Consumer spending remains strong. Real wages and incomes are growing, and that's a real wind in the sails of the American consumer, as well as some breathing room for households. So we see this transition to a more steady, stable growth path as ongoing, and what the Fed did yesterday seems complementary to that from our perspective.
So, Jared, the way you characterize the economy, it seems, relatively optimistic, right? And I'm just curious why, if that's true, why you think your administration gets so little credit for it, Jared. I'm looking at Biden's approval rating on the economy per Real Clear Politics average, Jared. He's underwater. It's just 38%. Why is that? Square that circle for me.
Well, there's a lot going on in that number. It's not just how people feel the economy. I mean, scholars have dug into that. It reflects partisanship. It reflects increasing negative bias in the news. It also reflects an interesting dynamic that I think has had a lot of people scratching their heads. A majority of people say that their financial condition is pretty good. Even that of their town or their state is pretty good, but that of the overall economy is less good. And I think that speaks to some of the general nervousness about where things are headed politically if we end up with a situation where the rule of law is compromised or where federal independence is compromised, a lot of things that would make markets and geopolitics pretty nervous. I think on the overall economy, people are still dealing with prices that are still too high. And that's why seeing lower inflation, lower interest rates, very big story as of yesterday, and the cost-cutting measures that we're engaged in here to lower the cost of housing, of childcare, of healthcare, prescription drugs, junk fees, all of that seems, again, to should close that gap between indicators and vibes.
But Jared, I mean, isn't there actually some data we can point to that would explain that sentiment? I mean, wasn't real income growth under Trump stronger than it was under Biden?
No, I mean, I think if you look at the gains in real wages, if you look at the gains in disposable income, you'll see comparable growth rates. And certainly, if you look from when the president got here and things started improving relative to when Trump left. I mean, I was just looking at a number. Actually, the president cited this number in his speech today. Over his watch, manufacturing jobs are up 740,000. Under Trump's watch, manufacturing jobs were down 170,000. And of course, when he left, the unemployment rate was much higher than it is today. So I think that if you look at, I think the key point here is that under this administration, and certainly the Fed has played a role, we've seen not just lower inflation, not just disinflation, but we've seen disinflation in the context of a much stronger economy than almost anyone expected. I mean, there were major news outlets guaranteeing us 100% probability of recession in 2023. Obviously, we didn't see that, and you heard Powell report yesterday on a pretty positive outlook.
We've been talking a little bit, Jared, about perception, too, which is obviously an important part of the equation when it comes to the economy, because what people spend depends in part on how they feel. And we know that the perception of President Biden's handling of the economy has not been fantastic. There is some new polling data out, though, that shows that Vice President Harris is getting better marks, that her polling is more closely approaching that of former President Trump when it comes specifically to perception of handling of the economy. Do you think, and I know you can only say so much about when it comes to the election, but do you think it's a matter of people wanting to turn the page, whatever that might entail, put that inflation behind them? I mean, how are you thinking about that?
I mean, I'll give you a bit of a response to that, but I want to jump in on something you said that I don't really agree with. You said something about how people's feelings dictate how they spend, and I know that that's a convention. I'm not saying that you're clearly wrong about that. It's a very conventional connection, and it's one that we've all grown up believing. It doesn't seem to be the case right now, right? I mean, we have the vibe situation that we just talked about, and very strong consumer spending. I mean, one of the things that you'd actually kind of have to think about right now is looking not at just what people say, but at what they do, because it's pretty different. We have strong consumer spending. We have TSA reporting some of the highest travel numbers they're counting in their history. If you just in your own life go out to a restaurant, they tend to be very crowded. I'll give you a little anecdote from my own life that I suspect is pretty common these days. We went out the other night with some friends to a restaurant. We had a great time. We ate and drank freely. And, then we get the bill and we look at it and we're like, that's up there. And yet we went out and would do it again. And I think that's actually a pretty common dynamic right now. People are out there, they're spending, but they're still concerned about price levels. And I think that's across the board. I think the missing piece of the analysis sometime is that one reason that can occur, one reason that's ongoing, is because incomes and wages are rising. Okay, we just talked about different wage trajectories over different administrations. For the past year and a half, middle and low wage workers, their wage gains have beaten inflation for 18 months in a row. Okay, so yeah, you see you have a graph there showing 3.8% wage growth year over year. Inflation was 2.5% that month. That means real gains were 1.3%, and that's there's the inflation. So anyway, 1.3% real gains. That's 3.8 wage gains minus 2.5 inflation. That's a solid real gain.
Jared, good to see you. Thank you for joining us. Appreciate it.
My pleasure.